Jimmy. We are going live right now. So Jimmy, have your lunch ready, Jimmy?
I'm good, thank you. I've taken my lunch, thank you.
Okay, good to catch up with you on the Sunday afternoon. You looking quite good today.
Yeah, always.
Okay, so today, by the way, welcome everybody. So thank you for joining us this weekend. So once again, this is our series of market investing bro market talk, whereby Jimmy will share what's happening as per his background in US, and me sharing on what is going to happen in Singapore as per my background. So today, last week, I think one of the hot topic that people has been talking about in the financial world is actually this thing called the SPACs, SPAC, or Special Purpose Acquisition Companies. So of course, if you actually have caught the latest news, let me just share on the screen. Okay, so you actually caught the news of SPACs, actually going to start listing on the Singapore exchange. So today we actually just want to talk a bit about what exactly is SPACs, and hey, as an investor, what should you look out for? Now, what exactly is a SPAC? So of course, again, SPAC is a special purpose acquisition companies. As per this article says, blank check shell companies formed by growth investors, called sponsors. So they raise cash through IPO, and then after that acquire company. So why do they actually do that? So this will allow companies to get listed faster than a traditional IPO, as per what article says, and of course potentially it can actually have stronger valuation. So in short, it can actually make the market more active, get more companies listed. It's easier for companies to have access to funds. In that sense, is make the market a little bit more active. I think that's what the purpose of SPAC is. Now, just in case if you all need to have a pictorial of what exactly is SPACs. So basically SPACs, this is a company, like I said, it's a shell company, get listed. So upon listing, there's actually no underlying business. Okay, inside is empty, no business. Okay, but then this empty shell, you get listed first. So the purpose of this thing is actually to raise money. So this company has money, no business. And for the SPACs, within the 24 months, they are supposed to go and acquire a company. Then obviously, this company is going to be under SPACs, and of course, it's got the SPACs going to be the owner of this company, and of course, benefiting the profits. So that is actually what SPAC is. Okay, so of course, before we go into comment on whether good or no good, what investors should look out for. So, Jimmy, understand that SPACs in US has started. You want to share a bit of how is SPAC doing in US?
Okay, so thank you, Emain. So Emain has actually make it very correct in terms of what is SPACs. It's basically an empty shelf company. The concept itself is not new. It has been going on, very popular in the US market in last year. And it was actually pioneered by this gentleman called Chatham. He basically is the top range of the SPACs lover creators. And some of the SPACs that has been listed in the US has been doing exceptionally well late last year. For example, BKNG, DraftKings, some of the EV stocks in LiDARs. So they basically perform extraordinarily well and have a huge return for investors, when SPACs was actually merged with a real business and become a stocks, listed in the US market itself. So I'm going to quickly show you exactly how the operation in the US. So let me just bring up my screen quickly. So this SPAC itself is a shell company, public listed, and its purpose is basically to acquire new and set up companies. So in the US, they are typically 2 floor price. So it's either $10 per unit or $20 per unit. The amount to raise during these SPACs typically in the region of about $200 million US. That's basically how it is. Now, like what Emain has mentioned, it is only a shell company that's no financial, no business. So the good whether to invest in the SPACs or not is typically solely judged on the founders of of the SPACs itself. Who are the sponsors? Who are the people behind all this? I mean, it's like if the fund manager itself is somebody that you already know has a proven track records, then typically these SPACs will be more supported by the market compared to those who are unfamiliar with it. Now, SPACs, although in late last year is almost like a sure win bet, but of course in today's market is really not that so, because as you can imagine, good companies that they want to acquire is getting less and less, and therefore, all these fund manager, these SPACs, when they try to target to acquire all this good business, are getting lesser and lesser. So before SPACs can identify a target to acquire itself, it is actually very, very high risk, high return, especially when there's a speculation from a floor price of $10, and being speculated to, let's say, $13, $14, which is like 30%, 40% premium. Then you are into what we call, very, very risky positions, right? Now, of course, you can always say that, yeah, but I always guaranteed the floor price, if the acquisition did not take place. So I can always get back my $10 or my $20. Yes, you can say that. But then again, if you want to invest in SPACs, you have to make sure that this is the kind of risk that you are into. If you're buying something at $11 or $12, you are essentially paying 10 to 20% premium on the floor price itself. Now, SPACs is not suitable for pensions or value investors. So if you belongs to these two group of investors, strongly against you guys to invest in SPACs itself. Now, I will just basically show you an example of what is coming up of SPACs. Now, this is one of the SPACs that's very, very popular right now in the US market. Is called the CM Life Science. Ticker is CMLT. So they really have a acquisitions target, which is called the EQR. It's a pharmaceutical company and committed to develop new medicines, especially the very expensive medicines, coming in and produce it at a lower price, right? And they have a very specific target. They only invest in the company which basically at their late stage of a launch. So we know that in medical, there is FDA stage 1, stage 2, and stage 3. They only invest in the late stage. So meaning to say that they are trying to reduce the risk. But then still, CMLT is still a SPACs, right? It has not officially merged with this EQR yet. So at this point of time, the SPACs itself, the price is very volatile. And whether to invest or not, obviously, we want to look at who are the major sponsors behind this. So now we have SoftBank, Fidelity, BN's Capitals. That's basically give us an idea of who are the people behind the scene. And then you can actually go up there and decide whether if these SPACs meet your target or not. So at this point of time, everything is all like gamble. I will use the word gamble because, everything, when we are talking about acquisition target of EQR, trust me, at 2, 3, 5, 9, all this thing can pull off. Just pull a plug, everything will just go, dark. So there are certain risks that involve in these areas. So yeah, so that's basically all about SPACs. Over back to you, Evelyn.
Thank you so much, Jimmy. Okay, so I just want to comment on how is Singapore SPAC slightly different, and of course I just want to probably focus on one point that Jimmy has sort of mentioned just now, is higher risk. Okay, so I don't deny the fact that the SPAC is probably a slightly higher risk compared to the traditional way of getting listing. So of course, SGX also has put in certain listing framework or risk mitigating measures to actually sort of manage the risk. Okay, so no doubt, okay, I do agree that it's going to be higher risk compared to traditional way of doing things. There are certain risk mitigating measures in place. I'm actually not going to go through one by one. If you're interested, you can just go Google SPAC Singapore. So all these pages will come out. So you may want to check out the SGX one. So this is the list of the framework they have to go through, or the measures that are in place to make sure that the risk is managed. So the other website that I actually saw that I thought was quite good was this one by Allen and Granhill. Is actually a legal firm. So again, how you get to this web page, you can just go Google SPAC Singapore, and maybe you want to check out the one by Allen Granhill. I thought it's actually quite good. So they actually have listed down the various conditions. Okay. From there you can actually see whether the risk is it well mitigated enough. Now I just want to give my opinion. Okay, I just want to give my opinion. Let me just put myself I just want to give my personal opinion on the risk that I mentioned. So maybe it's easier to see if you actually compare with a traditional listing process. So what SPAC does here is this. So basically for SPACs, you get listed on the exchange first. Okay, so of course it's a lot easier because it's just money. Then after that, you go and buy the businesses. So compared to the traditional listing process, so this company, you must have an existing business with track record. Then after I get listed, so the listing process is actually a bit more thorough because you have the professionals to go and do due diligence on the current business, make sure the business is good. Then after that, the business is approved by SGX and MAS, then you actually get listed on exchange. So I think a lot of people in the opinion is definitely more risky because, hey, the traditional one, you will have a lot of due diligence on the business first, then you allow in the listing. Whereas for SPACs, it seems like, okay, I'm quite sure when they actually want to put the business into SPACs, there will be some approval process, but it seems like it's going to be less stringent. Okay, so my point here is this. Yes, I agree, maybe there is a certain increase in level of risk, okay, but number one, that is what investing is about. You cannot have a risk-free investment in that sense. Everything is risky. So I agree that there's additional risk. Whether it's suitable for you or not, then it depends on your risk appetite. Okay, but I want to say here is this is not like out of the blue game changer or never have been done before. Like for example, for a current listed company, okay, they can also go and acquire a new business. Okay, it's not like, okay, let's say for example, this company get listed, they cannot buy a subsidiary or go and buy a new business. So they can also acquire a new business. So in that sense, again, in that sense, it's not like something that have never been done before. Listed company to acquire business. So the thinking behind is actually quite the same. And of course, maybe some of you know that currently in the market, we also allow this thing called reverse takeover. Okay, that means let's say an unlisted entity, okay, go and buy over a listed company, and then use the listed company to acquire the unlisted business. So this is also currently able to do using the current framework. So my point here is this: it's not like totally new. We are in uncharted waters. No. So this has been happening. So in short, higher risk. Yes, I agree. Suitable for you, not depend on risk appetite. Okay, but I don't think it's something that you should ignore totally. So I think it's going to be quite interesting. I'm waiting for the first SPAC to get listed, and of course, by then I think we are able to give you more info or more analysis of it. Okay, I think that's all I have. Jimmy, you got anything else to add?
No more, thank you.
Okay, great. So this is episode 5 of Investing Bro Market Talk. So hopefully you have been learned something from this video. Of course, if you think what we do makes sense, do us a favor, click on the subscribe button or give us some comments so that we are actually motivated to actually do more of such videos. With that, thank you so much, and I hope to see you again in our next episode. Bye and take care. Bye-bye.